So stock goes up, stock goes down. How can you understand what's going on? Today, we're looking at this price confusion, and I have some solutions for you. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend growth investors, bonjour, Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Vero, and today we're doing something that we never did in 6-7 years of podcasts, like hundreds of episodes,
That's
and
right.
still we have something new. So how are you doing, Vero? And what are we doing today?
Well, I'm doing good, of course, because I was thinking about last week. We hosted a completely new webinar about stock price confusion, and we got so much great feedback from it that I thought, let's do a summary here. If you were not able to join last week, this is your chance to get an excellent overview before watching the entire replay, the dividendguyblog.com/webinar. And if you were an attendee, don't go away just yet, because I know what it is, right? I've done it before. You register for a webinar, you come in there, you start scrolling down your social, you hear the dogs barking, or maybe you got in late because of work. Work sometimes it gets in the way, and you end up forgetting all of it. So today is your well-deserved webinar recap, Mike.
So are you saying, Vero, that sometimes when I'm doing the webinar, you don't listen to what I'm saying? Is it what I'm understanding right now?
Well, as you know, I'm in the chat, so I'm kind of busy, to be honest with you. I don't always listen. To be fair, I don't.
That's all good. So you'll have the refresh as well on your side. And of course, we're not going to deep
Yeah.
dive into all the topics, but the idea was to give you the short version with the idea. And if you like it, well, there's a lot more, including the slides, including some newsletters references as well in the webinar. So you will definitely get a lot more information over there.
Right. So first, Mike, how did you get the inspiration to create a webinar around stock price confusion?
So, it's kind of funny because the idea about talking about price confusion is not that clear, right? You're just like, oh, really? People are just wondering this? But what I realized, I've been doing webinars since 2017. It's been 8 years of webinars. And after each presentation, we do a live Q&A of an hour. And the most common question is always, what do you think of stock ABC? And of course, I know a lot of those. And sometimes if I don't know the stock or I just want to have a fresh memory of everything, I'm just going to pull it out using Dividend Stocks Rock on the side while I'm answering the question. And then I look at the graph and two things happens. Either the stock price is skyrocketing, so people want to literally to know, is it still the good time to get in that position because it doubled in value over the past 12 months and it's kind of crazy? Or it's the opposite. The stock price goes down like there's no tomorrow. And then investors wonder, should I keep? Should I buy more? Should I sell and move on? What do you think of stock ABC is really, I don't know what's going on with that stock price. And I'm wondering if I should buy or sell or simply hold. And please guide me through this. And this is where I thought, well, I do have tips. I do have a strategy for that. I can share those information and this framework for investors to actually be able to answer that question by themselves.
So the framework that you build for investor is to understand what's happening with their holdings, but most of all, take control. And it starts with knowing what you own and why you own it. As Peter Lynch said, I think that we probably mentioned that quote 100 times.
I actually receive a mail from his lawyer and he's asking for a royalty now because I see it so often.
But concretely, what does it mean? And it includes two parts, the investment thesis and the potential risks. So could you summarize what information you'd put in these two categories?
Yeah, it's super important before we get to what move a stock price or an ETF price in time. You have to go back to the basics, meaning you need to know what's in your portfolio. And ironically, a lot of investors Their investment thesis, basically, the reason why they bought a stock is probably something like, oh, I heard about that stock on whatever platform I'm listening to or I'm watching. So I'm watching on TV, YouTube, podcast, whatever. Mike said National Bank is great. So I bought my National Bank because I read a couple of like blog articles and it sounds good. So I thought, well, good returns and everything. So I'm going to add it to my portfolio. So when the stock price starts to move fast on either way, either up or down, they really don't know what's going on. And they don't know because they absolutely have no clue what's National Bank. They just, I mean, it's just a ticker, pays a dividend, sounds great because so and so talked about it. So the point here is to write down your investment thesis. And your investment thesis is all the good reasons why you like a stock, why you think this company will generate more profit in the future. That's the narrative, the story you tell yourself and the story you can tell somebody else about the company to summarize why you like it. And at
Mm-hmm.
Dividend Stocks Rock, we created this framework to help investors to understand a little bit better. So we separated in 3 categories. So first, you have to define the playbook. So the playbook is literally how the company generate money, like literally just like what's the business model here. So then you have better understanding. After that, we move to growth vectors because it's one thing to have a business, but how this business is going to continue to grow. So increase their sales, increase their profit, and hopefully increase their dividend, right? And finally, you have to define the economic moat, or you can say competitive advantage as well. So
Mm-hmm.
what makes this company better than others, or what could protect this company from something else? And I would like to do something a little bit different than usual. So I want you to name a stock, like any company that you can think of, and we're going to run the playbook, the growth vector, and the economic moat like shortly. So please name one that I know.
Well, Mike, the first one that came to my mind, basically because you always talk about it, is Alimentation Couche-Tard. But I'm trying to think about something else
Yeah.
to maybe do something different. Well, what about Nike?
Perfect. Good example. And especially because right now the stock price not doing that great. So
Right.
adding more questions here. So playbook for Nike, relatively simple instead of like they're selling shoes and sports apparel. They have like a good brand over there. And most of their playbook is to go through distribution channels like all the sport checks and food lockers of this world and selling their merchandise across the world through retailers. Over time, they moved also towards direct to consumer. So they have their own website and they try to do online businesses, which actually is one of the reasons why it affected the overall sales is they kind of burned some of their retailers. So the playbook is pretty much this. And in terms of marketing, well, they are known to sponsor major players across all sports. So the point is quite
Mm-hmm.
simple. You're watching any kind of sports, your favorite player is wearing like a Nike shirt or a Nike shoes, and then you're just thinking, well, I'm going to start running tomorrow. And of course, I'm going to buy Nike shoes, or I'm going to play basketball, and of course, I'm going to buy Nike shoes. So that's the playbook. The growth vector, well, the more stars they can have, the better it is. So it's a lot about reinvesting in terms of marketing. So that is one of the biggest growth vector here. Innovation as well. They made an amazing move when they created the Air Jordan back then, and now it's
Mm-hmm.
business by itself. So whenever they are able to do that, they're going to attract a lot more customers as well. And if not, well, economic growth, population growth, of course, they're pretty much all across the world. So it's a little bit harder for them to develop new markets. There is still room in emerging markets as well. In terms of economic mode, I mean, you're selling shoes. So of course, Adidas can make shoes as well, and there's not much here. So the only thing that protects Nike more than others is their brand. They have a very strong brand, and actually we can see that. It's kind of funny because we went not too long ago to buy indoor soccer shoes for my youngest son, Caleb. And of course, he swears only by Adidas. So there was not that many options there. It was like Pumas and Nikes where we went. And well, I mean, we just went back to the truck and then that was it. Like that was, we just didn't buy it because there was not like that brand. So the economic mode there is still very strong. If you love this one or not, that's going to make a big difference. But still, a shoe can be seen as a commodity for a lot of people. Same thing with a t-shirt and stuff. So yes, it's an interesting mode, but it's not that strong. The other thing is, of
Mm-hmm.
course, economies of scale because they operate everywhere. So the distribution is really strong. But that's pretty much the investment narrative here. Now we're going to move into the risk potential because we just talked about about the good stuff now, but of course, Nike has business weaknesses. The first one is actually the fact that they have burned their relationship a little bit with the retailers, trying to sell their stuff by their own and kind of like
Mm-hmm.
ignoring a little bit retailers on the side. So of course now retailers are just like, okay, so we're just gonna like sell other type of shoes, other sports apparel, and you can walk away. You're just going to have less shelf space in our stores. So that's the problem.
Right.
The other thing is they are selling articles that because of they have like a good brand, it's not cheap. So it's great when the economy goes well, but on the other side, it's not so great when you're trying to convince consumers with a tight budget to spend like over $100 on a pair of shoes. In terms of
Mm-hmm.
market and industry threats, I would say one of the major thing on top of the fact that it's a cyclical business is the tariffs. Like definitely that has been a major talk over the entire year of 2025. They are highly dependent on how it's going to play out because they manufacture all their stuff not in the US. So
Mm-hmm.
because of that, they are facing a lot of margin pressure. It's going to be a lot harder to grow. And it comes at the same time where the economy is slowing down a little bit. Consumers are not going to be willing to spend that much on sports apparel. So for another reason, the sales are going down and the margin is still under pressure. And then finally, when you identified like the internal threats, which are the business weaknesses, and then market and industry threats, which are external, which they don't have much power over, you have competitors. And what is interesting when you look at competitors, I mean, I mentioned Adidas, it could be Pumas, it could be like a lot of like Skechers. There's a lot of like other companies in this field. What I
Mm-hmm.
like about doing this is to compare their financial metrics, but also sometimes as you dig into competitors, you're going to find another company that is actually better than the one that you wanted to buy. But the point here is once you've done this overall look of the investment thesis, so all the good reasons why I like this stock and all the bad reasons maybe I'm going to lose money, like all the risk potential, then you know exactly what you have in your portfolio and why you have it. And no business model is perfect. They all have flaws as well. And it's important to be able to describe that on the fly, as I just did for Nike, that is being understandable for 12 years old. It has to be very simple. So then you understand clearly. If you're not able to do that, you're probably missing one part and you increase your danger because you're getting blindsided by a part of that business that you don't know where it's going and why.
So, listeners, we did an entire episode on how to craft an investment thesis. You can grab the link to it in the show notes at dividendguyblog.com/246. Now, Mike, another big part of the answer about stock price confusion is in the quarterly earnings. Why is it so?
So the earnings are going to drive short-term price big time. And in the quarterly earnings, you're going to have first the results. So then it's one time every 3 months where you get news from the company that is quite precise about the revenue, the earnings, and so on, all the metrics, literally what happened. So you have the results. You also have the expectations. So analysts have their own expectations, and then sometimes you will see something weird, meaning you're going to have a company showing 8% revenue growth, which is pretty cool. But if analysts expected 12%, they fell short big time. And therefore, the stock price can move accordingly just because of that. So it's a lot about the expectations because financial analysts and financial firms will give a price target to a stock based on their assumptions. So if you're way off compared to the assumptions on the one side or another, I mean, again, if they expected 12% growth and you pull out like 25% revenue growth, well, then the stock price is going to rise because then you're just saying, oh my God, I mean, we expected that it was going to be a good quarter, but it's an amazing quarter. Let's buy more.
Mhm.
More information that you're going to find in the earnings as well is about what's going to come up next. So you have the past 3 months, you have the expectations, and you have the guidance. So guidance at the beginning of the year is really important because they're going to hand in hands be aligned with the expectations or not with analysts. So once again, could have a very good quarter, but say, hey, you know what? For the second half of the year, we're going to see a slowdown. Well, if analysts expected no slowdown, and then you're telling them, well, their guidance has been revised and we'll see less revenue and pressure on the margin, again, it's going to have an influence on the stock price. It is also including all the important news. So did they make acquisitions? Did they sell something? Is there a lawsuit? All of those things are going to be published in the quarterly earnings. So it will give you a good overview of what is happening with the stock right now. And most of the time, this is what will drive most of the short-term fluctuation that you see, either the stock price skyrocketing or dropping like a rock.
And what's typically inside quarterly earnings?
So there's a lot of stuff there. When we think about quarterly earnings, most people will think about financial statements, which is not the first thing that I'm looking at right now, because of course, if you want to go through those financial statements, those are like dozens and dozens of pages and charts, and it's boring and it's daunting, and it's probably not that effective to go through all of this, especially if you have like 40 stocks in your portfolio. So the first part of the quarterly earnings that I find very interesting is actually the press release. So this is usually a couple of pages and you get all the highlights. So it's important to start with this because it's going to tell you the most important information. So kind of like using the Pareto principle here, that's like 20% of the content that you can consume from the quarterly earnings. That is going to give you the 80% overview right away. You also have investors presentation. I like when companies will offer the press release and the investors presentation in complement to the financial statements. It's not always the case, but I just love to see those PDFs or PowerPoints so I can have a visual. And when you see graphs and stuff, it's just easier to understand what's going on. So you start by reading the press release, then you have the investors presentation, and then you have a very good idea of like how you can wrap up this quarter for this business. If you have like deeper question, we're going to get there in a moment. Then you have the financial statements that are a little bit more daunting, but sometimes it's necessary. A good example would be about a year and a half ago, I went into a deep dive into financial statements for BCE before they cut their dividend, because I just wanted to have a real feeling of what was going on with interest charges, how it affected margin and their ability to pay the dividend. So I had to go through the financial statements, looking at all the debts, the maturities, and then looking at the interest charges to see how it moved quarter over quarter, year over year, and where it's going, and compare the interest charges versus the free cash flow and how much they paid in dividend. So that's a lot of numbers. That's a lot of operations. But I mean, if you really want to avoid a dividend cut, this is sometimes a step that is important. And finally, you have the press release, the investors presentation, the financial statements, and if you're still bored on your Sunday afternoon, you can listen to the earnings call. So, and the earnings calls is literally the CEO and management team trying to sell you that quarter, telling you how great it was, how amazing they are. And then you have financial analysts at the end asking questions. So sometimes you're going to see some interesting information, especially if the CEO is trying to not hide, but kind of like not talk about something that is, or just briefly say something bad about the quarter. Well, then financial analysts may just hammer down this nail and say, hey, I want to go back to this point. I need more information. I need more feedback, or here are my question of what you're going to do going forward. So those are like the four things that you're going to find inside a quarterly earnings.
And you know what? Like, I realize how much I love my DSR membership right now because this is a lot of words, a lot of graphics. And what exactly should we look for in all of that stuff?
I know. I mean, unless you're a passionate investor like me, probably that what I just described there sounds like a ton of work that is not that much fun. Fortunately, what we do at DSR Pro is we have a team of analysts that goes through all of this and create a summary. So literally you just have to generate your pro report every quarter and read like half a page instead of like going through dozens and dozens of pages and graphs.
Right.
So what we do, actually, I'm going to talk about what like how our analysts are looking at those earnings. And this could be quite interesting for you guys. So the first thing is we go into the press release and we look for the highlights, because those are like the bullet points telling us what really happened within this quarter. In the highlights, you'll see what happened with the revenue, what happened with the earnings per share, if there's a dividend payment, and if there's a dividend increase. So those are like super important key points, because at first you want to know, is it business as usual or is something else is happening? So this is where you're going to see the revenue growth, the earnings per share growth. That is going to give you a feel. So if you, for example, moment that you will have to dig a little bit further would be you have revenue growth of 10%, but earnings per share up 2. I mean, that doesn't make much sense. There's a discrepancy here. In an ideal world, we would have almost the same growth for revenue and then for earnings, meaning that the margin are the same. And for each dollar that you're making a sell, you're making 25 cents of profit and it's always stable. that's kind of what we would like to see. If there's a discrepancy, you'll have to dig a little bit further. So those are the things that we're looking at in the highlights. Then comes the CEO comments. There's always kind of like a short clip, a couple of sentences where the CEO will tell you a little bit about the quarter. This is where you're going to see if there's any important news as well, because they're going to be super proud if they made an acquisition or if they're successful.
Mm-hmm.
I mean, always keep in mind the CEO's job is to tell you how great they are, not how bad they are. So you have to take that as a
Right.
grain of salt and look at numbers and then read what they have to say. But at least you get the overall feeling of the management team. In the press release, you'll also have the guidance. So at the beginning of the fiscal year, you're going to have like new guidance telling you, hey, here's how the year is going to happen. This is what we expect in terms of revenue, the margin, the earnings per share. And throughout quarters, like throughout the years, I mean, then they're going to reaffirm their guidance or they're going to revise them. Because, of course, you're making all those plans, everything is fine. But then 6 months later down the road, maybe things have changed. So they will tell you about it. Finally, you will have like some highlights about important news, as I mentioned. And one thing that is super important for investors is there's a part of what I would call education in those press release. Education in
Mm-hmm.
the sense that it's going to tell you where management focuses on. So for some companies, for example, they're not focusing on earnings, but rather on net income or on distributable earnings or distributable cash flow. It's going to educate you on how you can see and read financial statements for that specific company because,
Mm-hmm.
and then this is where you can see we go full circle. You should already know that by writing down your investment thesis and being aware of the potential risks. But now we have the same thing in the quarterly earnings telling you, oh, yeah, well, we focus on FFO per share. It's not about earnings. Well, you should have known that before. If you have skipped that part, well, they're going to remind you where to look because they're going, of course, report the earnings, but they're going to put a lot more emphasis on the FFO per share, which is funds from operation per share instead. So it helps you understand what are the key metrics to follow.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you.
All right, so during the webinar, you went into more detail and even provided a cheat sheet. Again, listeners, you can watch the free replay at thedividendguyblog.com/webinar. But to make things concrete today, Mike, please share an example.
Yeah, so there are like 6 parts that are very important in any quarterly earnings. And this is what we explained during the webinar. So the first part is really understanding what's going on with the revenue. So is it organic? Meaning that is it just business as usual growing? If we're thinking about like retailers or restaurants, we're going to talk about same store sales, for example. So same store is interesting because those stores existed last year. So you just want to compare with them because you could grow by opening more stores. But then if your existing stores are seeing a slowdown in the revenue, that tells the investors, well, the moment they stop opening new stores, they're going to start showing weaker revenue and declining revenue, which is a red flag, of course. And then you need to investigate a little bit more. It could be driven by acquisition as well. So that sounds super great when you have like 30% revenue growth year over year. But if that 30% is driven by one single acquisition that represents 28% of that growth, well, that means that you barely grew your original business. And to be able to keep on those double digit, again, you'll have to keep on making acquisitions. There are also explanation about differentiation. So for a company like Procter & Gamble, for example, exchange rate are super important because roughly half of their products are not sold in US dollars. So
Mm-hmm.
sometimes going to be positive, sometimes going to be negative. So if you see revenue growth down 2%, but in current dollars, it's up 3%, it means that there's an FX impact of 5% on it. But at least the company is making money, it's growing, it's just something out of their control. And that could play on both ways. We have similar thinking when you look at earnings per share, the EPS. So first, then you need to know which metrics to use. Is it the EPS or the FFO or the distributable earnings and so on? You have to make the difference between adjusted and GAAP earnings. I prefer adjusted, but Of course, you have to look at them over the long run. The adjusted will take off all the one-time event that happened.
Mm-hmm.
Yes, it's true. So it's part of the gap earnings. But next year, it's not going to likely happen. So then it's better to understand that part and also understand what is going on. Do they have like more expenses? Do they have like more amortization, or is it the opposite? So sometimes they're just like, yeah, we recovered some amortization. Well, then it's not real money. It's just like playing around the numbers. It will have no impact on the cash flow. So that is also important to understand. The third part is the margin. So again, the relationship between the revenue and the earnings going to lead to your margin. So is it stable? Is it growing? Is it declining? Is it permanent? Is it temporary? All those questions needs to be answered inside the quarterly earnings, because it's one thing to see if the revenue and the earnings are doing well. Then you need to make sure that the company continues to make profit every time they sell something. Now, on the fourth part is the CEO comments. So he's going to tell you what happened, what's going on, where they're going. So it's always interesting to see the feel. Is the CEO comment seems defensive, like trying to say, yeah, it was a really good quarter, even if we got hurt by this and that. I mean, then you can understand, yeah, well, it's not really a good quarter. Like, don't tell me it's a good quarter
Mm-hmm.
when like down high single digit for both revenue and earnings. You cannot really say it was good. So sometimes it's going to help you, I mean, giving credit or not giving credit to this CEO. Guidance, as I said, super important to see if they are reaffirmed, revised, upgraded. It's always positive. That's always good news. And finally, and a very important part for me is capital allocation. So how the business is using its cash. Do they pay a dividend? Did they increase it or cut it down? Do they have a share buyback program? Are they buying back shares right now? Are they issuing debt or paying off debt? So sometimes they say, oh, yeah, we sold this business segment, but we're going to use most of it for paying back the debts, for example. So that could be interesting. So it's going to tell you a little bit more on how they use their capital throughout the quarter and in the quarter to come. Because if they issue a new buyback program, it's going to be available for several quarters. And that should help earnings along the way, of course.
All right, but Mike, what happens if we dive into the quarterly earnings and still don't get why the stock price is skyrocketing or why is it down?
So at this point, you have spent some decent time on reading the quarterly earnings, especially the press release and the investors presentation. If you still have questions, now it's time to dig into the numbers. So you'll go into the financial statements, as I mentioned with Bell, then you have to dig a little bit further, yet it becomes more technical, but you don't really have a choice here. Another thing that you can do though is to get into the earnings call transcript and you can copy paste them into AI. So you can use ChatGPT, for example, and then you can ask for a
Mm-hmm.
summary of the earnings calls. Or if you really have a question about, yeah, well, why the stock price is moving, or like what is the good or the bad thing that happened in the quarter, well, then you can ask ChatGPT instead of like going through 30 minutes of earnings call transcript, because again, that could be quite long. So you can download the financial statement, download the earnings calls, put that into AI, and then it's going to fast forward your research a little bit, especially if you know what you're looking for. And most of the time, financial analysts are going to ask the questions that you have in mind or you're curious about, because I mean, that's their job. And one other trait that you could have if you're a member at Dividend Stocks Rock is simply just ask your questions, because we do those webinars every month. So we have private webinars for our members where I get tons of questions like this. So I do that work for you guys. So if it's not enough to get the pro report and the overview and you still have questions, you don't have to feel bad about it. This is what we do. We provide that information, we make it clear, we clear out the noise. I would say what really drives those stock prices usually based on the numbers versus the expectations. It's a big thing here because it's all about the expectations, because sometimes it will be a good quarter even though the numbers are bad. And that just happened with Alimentation Couche-Tard not too long ago. So not to talk about it today. They reported declining revenue and declining earnings, and the stock price jumped about 6% on that day. And then people were just like, but Mike, you're saying it's a bad quarter, but the stock price goes up. And I'm like, yes, because expectations were worse. And analysts like where the company was going because there were a lot of interesting things inside the quarterly earnings showing signs of improvements, such as same-store sales for the convenience stores that were growing across all countries. So in Canada, and US, and Europe as well. So sometimes you will see bad news being transferred into good news and the opposite. And sometimes the good news will be a good news, and that's great as well. So it's just a matter of understanding what was the expectation versus the results that you just saw.
And Mike, we could say that we can have a good feeling of what's happening by looking at the dividend triangle, but it may seem too simplistic to say that the dividend triangle covers it all, right? So please explain why revenue, EPS, and dividend growth are the signs of a healthy business, regardless of its price.
Well, as I said earlier today, what drives the stock price? Well, it will be a combination of financial results and expectations. That's pretty much it. So either we all believe that this company is going to do well in the future, and therefore we're going to put our money right away. So that's going to drive the stock price up, or we don't believe in it, and then it's going to drive the price stock down. The other thing that really drives the stock price is earnings over time, because no matter what we believe, if the company keeps on generating more profit year after year, well, then eventually the stock price will follow as well. So it's really about the line between the results and the expectation, and that creates a lot of noise. What I love about the dividend triangle is that it's purely numbers. So you pull out three graphs on actually one graph where you see the three lines. You see the trend for revenue, you see the trend for earnings, and you see the trend for dividend. By definition, if a business sells more quarter after quarter all the time, I mean, this is what we want as investors. We want a company that found a way to always increase their revenue. After that, what we want is that company to generate profit. So earnings per share over time that is growing, aligned with the revenue, is going to tell us about the margin, about the pricing power, and about is this company generating cash flow or just burning the cash all the time and hoping eventually to get something out of the market, which could be a good strategy. But then you know that there's a risk, because if they fail to generate profit at one point, well, you're going to pay the price as a shareholder. So the trinity of that triangle ends up with the dividend increases. So after making more sales and making more profit, if you are able to increase the dividend payment every year, then you have a very good sign that the business is healthy, because it goes circle back to everything is great. You cannot increase your dividend if you're struggling paying down your debt, or if you're not making enough profit. That doesn't make any sense, because there's no added value for the business to pay a dividend. It's literally money getting outside of their corporate account into your bank account. So if they cannot afford it, they're not going to increase the dividend. So it's a really good sign if those three metrics are positive over a long time, that the business is doing well. And when it happens, if you look at the earnings, you're probably going just to see business as usual, which is going to save you a lot of time, because that's the whole point. If you did the right research at the beginning, the quarterly review should not take you like 10 days. It should take you like a few minutes per company. And then once in a while, you're going to have to do a deep dive into one specific quarter for a business that is struggling at this point.
So then, because sometimes we see companies with like strong dividend triangles, but a confusing stock price. And after they getting into the quarterly earnings, we still don't get like why the stock price is volatile or down. I'm thinking about like a stock like Granite REIT, for example. That was a very good example for a long time. So is the answer at that point, it's just like it's noise. We should not care about
As you were formulating this question, I thought about Granite as well, because for a very long time, I mean, it's better in 25, but for years, the stock was not performing that well. And it's kind of confusing because all the financial metrics were doing great. And one thing that could explain that is, of course, the lack of interest from investors. I mean, you be selling the best thing ever if no one wants to buy it because they just don't want to buy it. Well, then your product is not worth much. So same goes for the company. REITs has not been that popular, and then there is probably a few other reasons, and this is why it's important to go back into checking all the risk potential. One thing that has not changed over all those years for Granite, for example, is their high exposure to Magna International. They have like 26-27% of their business. So a quarter, a little bit more than a quarter of their business related to have one tenant that is Magna International. And Magna International did not did that great over the past few years either. There's a lot of concern around the automotive industry as well. So for those reasons, it could explain why the stock has had a hard time to go up even after reporting pretty solid numbers, especially in the REITs world. Everything was growing. The payout ratio is under control. The distribution keeps on increasing. So all the things were there. So there's a lot of noise there, but also like sometimes a risk that the business is not able to take away from, and investors, they just don't want to take that risk anymore. Another thing that could happen is the analyst rating change. We see that a lot. If we have like big financial firms and they rate something from a buy to a hold, then you're going to automatically see some people selling. And that has like a great short-term pressure, but it's really like a few days. It's not something that I really look at, because I would really qualify that as noise, because I mean, one financial analyst perspective is one thing. I don't want to discredit that, but I mean, it's his opinion. I mean, it's maybe fair, but maybe he's wrong. Who knows? We're going to see that in the next 5 years, right? So trading based on somebody else's conviction, I'm not a big fan of that. I'd rather be under control of what I have in my portfolio and trade based on my conviction. If after all this, you have absolutely no clue why the stock price goes up or goes down, definitely you miss something on the investment thesis and on your overall analysis. So either you revise it, you can ask ChatGPT to challenge it, like ask AI to challenge your investment thesis. That could be a good reason to how to bounce back your ideas. Or simply you can assume that you don't understand the business altogether and it's probably not a good fit for your portfolio. It should not happen really often after you did all of that too as well. It's just a matter of like knowing really why you invest in stocks in the first place.
Right. All right. So in summary, the analyst framework consists of 3 steps to help mitigate confusion about the stock price. Number 1, know what you own, which includes business model, investment thesis, risk potential. Number 2, dig into the quarterly earnings review, press release, investors presentation, what moved, why, and if you need so, dig deeper into financial statements. And then at number 3, the dividend triangle. 3 metrics: revenue, EPS, and dividend growth. The trend is your friend here. Don't look at just a number. Look at the trend over a couple of years. And quarterly earnings, again, to find answers. Mike, is there anything you'd like to add?
Yeah, actually two small things, but very important. Don't give too much value on stock price movement, especially short term. That doesn't mean anything. That's pure noise, and you should not even look at that. Most of the time when people send me questions about a stock that goes up or down double digit, I'm not even aware of it, because I don't care, even if they're in my portfolio. Because you know what? If you track a stock price, like a relatively volatile stock in your portfolio, you're going to notice that high single digit or double digit movement happens several times in a year. So if every single time that the stock is up or down by 10%, you start doing digging and research and so on, I mean, you're just wasting a lot of energy for nothing. So don't give too much value on price movement. Give value to your analysis and to real numbers: the revenue, the earnings, the margin, the cash flow, the debt. Those are numbers that are important. Focus on your thesis and make sure that your thesis is backed by financial metrics. There's nothing that speaks louder than financial metrics when you're trying to write a good narrative.
Well, that was so informative and I must say relieving. So thanks a lot, Mike. Listeners, this was just a summary of the content available to you in the free replay, which also includes, by the way, over an hour of Mike answering live questions. So there might be like a lot of questions that you're asking yourself right now. The answers are in the replay. Watch it now at thedividendguyblog.com/webinar. For our show notes and related content like the How to Craft an Investment Thesis episode, visit thedividendguyblog.com/246. If you like what we do, thank us by hitting pause and the subscribe button underneath our podcast logo. You may as well leave us a 5-star rating while you're there. And until next week, stay invested.
Stay invested. Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence, as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.